My name is Chris Sandilands. I'm a partner at Oxbow Partners. For those of you who don't know us, we are an insurance-only consulting business, and we do quite a lot of work in insurtech. And if you end up agreeing with any of the things which I say today, then you might consider signing up to our blog, for which there's a link there. And we write quite a lot about insurtech in the London and European market. And it was on the back of one of those blog posts that we wrote that we've ended up doing quite a lot of work and thinking around the difference between hype and impact in insurtech. And that's kind of the theme of today's presentation. So the kind of, these are the sort of headlines which started winding us up about 6 months ago. So I've got a selection here of some of our favorites, but they're by no means unique, of course. But pretty much every headline about insurtech talks about revolutions, or AI being center stage, or things being reshaped by AI. And really, the question we were asking ourselves was, is this actually really true? And obviously, there's a question around what might happen way down somewhere in the future. But I think there's a different question around what is happening in the short term, and can we really, really see any impact at this stage? And so one thing I maybe should just say at the beginning of this presentation is that this isn't about somehow puncturing the insurtech balloon, but it's more about just thinking about some of the issues which sit behind insurtech and thinking about what the solutions to some of those issues are, which, frankly, will be the difference between whether insurtech has a future to reshape the market or whether it's just a whole load of technology that's being built but won't ever see any impact. But first, maybe just one or two things on the impact side, on the hype side. So lots of people are getting excited about insurtech, and this slide just gives you a little bit of the investor perspective. So on the left-hand side, we've just got the data from CB Insights, which is the amount of capital that's being invested in insurtech businesses. And one of the things that you can see, assuming you take out the anomaly in 2015, which was two really large financings in China and in America, the amount of money that is flowing into insurtech from investors is going very much in one direction. 2017, so far in H1, about $1 billion went into insurtechs, and that's about 2/3 of the entire total for 2016. So people are getting very excited, and there's a couple of names which I'm sure most of you, if not all of you, will all know. Lemonade, I've got there a bit earlier than the previous panel, by mentioning it, has raised over $60 million. And Trove, perhaps even more remarkably, has raised nearly $100 million. So some people clearly think that there is some serious change ahead for the insurance market. There's a little bit less data about whether any of these investments are actually bearing fruit. And maybe the panel which follows this will shed a bit more light on this. But the only company that really releases any meaningful data is, again, Lemonade. And the data point that they have released is that in the first 8 months of being in business, they got up to about 14,000 policies. And that was at the beginning of May, by the way. So one has to assume that that is now a significantly larger number. Pretty much every other startup doesn't release any data whatsoever. So you have really zero transparency about where they're getting to, apart from anecdotal conversations. And so the real question then is, what does this mean? And if you're a insurtech evangelist, you're going to definitely think that this is the beginning of something really, really huge. And there are plenty of those around, and I would argue there's most of them in the press. So every single headline, as I've already said, talks about the ginormous revolutionary impact of insurtech. But on the other hand, there's plenty of people who will tell you that this is all just a bubble. It's all been done. Direct Line came and went, did something new, everyone else is still around. Confused.com came along, all the motor insurers struggled for 5-6 years until they figured it out, and now it's just the normal market, and Aviva is still Aviva. And our view really is that it is just simply too early to know whether what we're seeing here is a major new development in insurtech, in the insurance market, or whether it is some incremental tool or some tools to create incremental change for what people are currently doing with their strategies anyway. And that brings me to one of the big questions around insurtech. And this is linked to some of the comments which people were making earlier about partnerships. Doing an insurtech business is really, really, really hard. Oops. Sorry, I haven't quite got the hang of my slide thing here. There we are. So doing an insurtech is really, really hard. And the reason for this is because if you're going to do anything around proposition or distribution, you have to engage with an insurance partner. Now, in the previous panel, we were talking about how that was a good thing and how the two sides of the startup and corporate divide can help each other. But the fact is that having to engage with a corporate is really, really hard and quite slow. And this is also a really esoteric point of difference for insurance, for pretty much any other industry. And so what this slide here shows is a picture of a bank, also from CB Insights. And what they've done is they've taken the HSBC website and they've put all the startups around the edges which compete with products that that bank offers. So just below the picture in the middle, there's the TransferWise logo. And for those of you who don't know, TransferWise do international payments at much better FX rates and at lower cost, therefore, than, say, HSBC. And another picture on there is Zopa, who I'm sure you also all know is a peer-to-peer lender attacking HSBC's sort of general lending product. And the thing about both of these businesses is, and this is by no way to belittle the actual technology and IP and other marketing things they have to build to be successful, but neither of those businesses really need HSBC to do anything special. So HSBC doesn't have to build a new product, they don't have to integrate stuff with their system, they don't need to particularly worry about strange risks which they might be assuming on their balance sheet. The only thing that HSBC really needs to give both of these businesses is a bank account, and really nothing else. And that is completely different in insurance if you're trying to do a new product or a new proposition, because you kind of always need someone with a balance sheet sitting behind you to take any of the unexpected losses, whether that's frequency or severity. And so some people have solved this by being insurance companies themselves. So Lemonade, for example, does a big marketing thing about being an insurer and not just a broker or a distributor. But when you think about it, that's not entirely solving the problem, because they still have reinsurers sitting behind them to take their losses. And actually, in their first regulatory report, which just came out, Lemonade showed that their reinsurers paid approximately 75% of all of their losses. So there's really no difference to being a broker or a primary insurer in that scenario. And ultimately, you're always beholden to whether the insurer allows you to do what you want to do or whether they restrict you. And so for that reason, what we're seeing in insurtech is impact possibly in slightly more subtle ways. Oops. Oops, sorry, I've probably gone too far now. But this slide here, okay, I hope that's going to say that. There seems to be a delay. But this slide here shows a variety of startups along the value chain. And it's only the left-hand column that you can see here, where people are actually in some way innovating around the marketing or the proposition that they're selling. So in our panel in a few minutes, we're going to have Dylan from Soshore and Tim from Slice. And both of those businesses are trying to sell and, trying to sell fundamentally different insurance products with a different fulfillment process behind them. But all of the other businesses on this chart are actually trying to help insurers do things better, but not to replace insurers. So to take an example, Cytora is a data business which allows insurers to get data from the unstructured web, so things like journalism or social media, and to turn that into a risk score which allows you to rate commercial properties with, they claim, better insight than historic insurance data. And so in all of these situations, the fundamentals of insurance aren't actually really going to change, but the only thing that changes is the way that existing incumbents interact with insurance companies, which in theory should lead to a better product or a cheaper fulfillment process or some combination of the two. The bad news for insurers here is that this doesn't necessarily mean that everything is fine. So making those changes on the value chain doesn't necessarily mean that everyone can sit back because this fabled disruption isn't going to happen. And so what I've shown on the next page, assuming I've done it better, I haven't. So what I've shown on this page here is another one of our infographics from our blog, where what we were trying to illustrate was how InsurTech could shift profit around the industry. And so you might not be able to read the words from the back in particular, but at the top, really, we've got three sections: brokers, insurers, and reinsurers, and at the bottom, a row called new distributors. And what we're trying to illustrate here is there are two fundamental ways in which we think that profit could be shifted in the industry in the next, call it 10 years. So number one points to what would be a shift of profit from incumbents to startups. So this is the kind of disruption that I guess most people expect when they talk about InsurTech. So in this situation, we've called out a company called SimpleSurance. They are a digital distributor of simple products on e-commerce websites. So in insurance terms, you might call that affinity. And those guys have a very good chance of intermediating people like the traditional brokers when it comes to setting up and administering affinity schemes. And if that happens, then I don't think the traditional incumbent brokers have a very strong response, given that they don't have this technology which easily links up, in this example, e-commerce sites with capacity. And so you would expect a shift of profit from brokers to new distributors. But equally, there could be a shift from incumbents to other incumbents. So if you don't think there's going to be any change in the way that insurance is distributed in the future, you could still see shifts of profit between insurers and other insurers. And here again is the example of Cytora, where if it's true that they can help you predict where your profitable market segments are better than traditional insurance technology, then you have to assume that those insurers who are quick to adopt Cytora in their processes will take market share or profit more broadly from those insurers who are still relying on old-fashioned ways of underwriting and pricing. And so the point really is that even if the market structure doesn't change, InsurTech has to be seen as a tool in which some market leaders will be able to differentiate themselves from market laggards. So the final thing before we move into the panel to discuss some of these things is, what does that mean for reinsurers and brokers? And there are two things which I think everyone in this room who, and I'm assuming that most of you work for reinsurers, insurers, or brokers, should be thinking about when you think about InsurTech. And the first one of those is, what is the impact of distribution, impact of InsurTech really going to be on distribution? So are some of these new digital businesses which are launching, SoSure and Slice, as we're about to talk to, for example, are they really going to change the way that insurance is distributed in the future? Because if you believe that, then it leads to a certain set of responses which are really important. But equally, If you think that isn't true, or if it's not materially true, then the question is how will insurers benefit from InsurTech more than other insurers? And both of those two things, I think, are analytical questions rather than just the hype questions where this all started. And then, clearly, the second part of all of this is how your actual company responds. So the first part of that is, does our company have a clear view of how those impacts will play out in the market, and do we therefore have a consistent view of what to do next? And in particular, and this is then the second question there, does that mean that we know where to focus? Because if there's one thing that's true about InsurTech, it's the fact that you cannot do everything. It is absolutely impossible, even for the big companies, to do literally everything. And so it's much better to focus on one thing which you can believe that you're going to get a competitive advantage from. The third point is then how you change the organization to realize those opportunities, because there's a big difference between knowing what you want to do and being able to do it, and then overall working out how you will win. And so my final thought is that I would encourage everyone here today not just to hear about all of the cool stuff that's happening, but to think about how it could really impact the industry. What are the barriers? What are the blocks? How do you overcome them? And how do you ultimately win in the market against everyone else who is in this room?